we are going to have a fun session. Yes, it is being recorded. I know some people asked that question too. I just got the pop-up right there. So we are recording this meeting. It is a meeting for earlier stage founders who probably haven't done a fundraising round yet. Maybe they're just considering it, or you are in the boot camp and you're in your prototyping and you're not even really sure when or how to approach this. So this is really an open, safe space to ask as many questions. We do have some interesting topics that Laith will cover, and I would encourage you to just ask questions in the Q&A as we go along. So maybe we will play it by ear with the questions. We'll see if there are more quick ones. I might just jump in and say, hey, Laith, do you mind answering this before we proceed? Or else, if there are more longer answers, we might take a break in between. If you get a lot of them, try to hammer them out and then jump and continue. So we'll just play it by ear, super casual. So feel free, as you have any questions that come to your mind, to just pop them into the Q&A. And we do have about an hour and a half booked off. I don't imagine us taking that long, but just in case, we have a great discussion going. It's like extra buffer time for us. So, all right, let me kick it off and just say that Laith is from the Silicon Valley Bank, and he will introduce himself. But the Silicon Valley Bank is part of our Professionals in Residence program. And the PIR program gives access to everyone to get one-on-one free strategic consultations with 5 different organizations. So one is Goodman's, Faskin, these are the 2 law firms. You have Logan Katz, which is an accounting firm. You have Think Shred, which does SR&ED consultations for the tax refund program by the CRA. And then our newest member, Silicon Valley Bank. And that is Laith's from SVB coming to speak with us today. And so ask him away. He has lots and lots of experience and questions. So I'm just going to hand it off to Laith now so he can do a quick intro and then we can dive right in.
Awesome. All right. Thank you, Sweeney. Just going to share my screen real quick so I can actually get things started. All right. So I just want to make sure and just kind of like get a quick thumbs up from the crowd if they can see the screen. You can see, okay, perfect, awesome. All right, so super casual. You have any questions, drop them in the chat and then we will tackle all of them right at the end. So literally any question that comes to mind, just drop that in there. So first off, DMZ crew, Sweeney, thank you for having me here. Thank you for having me this morning. Great pleasure to come here and talk to founders again. Real quick intro and background about myself. So I am the Senior Market Development Manager at SVB. And what that means is I oversee all our sort of partnerships with the different accelerators and incubators across Canada. I also wear a second hat where I work with all companies that are pre-Series A. So everything sort of from like pre-revenue all the way up to sort of like your post-seed, C2s, seed extensions, whatever you want to call it today. Previously, I was at Scale Up Ventures for about a year prior to joining SVB. And before that, even I was at DMZ. So I used to actually be in Emily's role. So when I joined in 2016, my job was basically to help build the capital program. So basically everything to do with investor relations, everything to do with sort of, fundraising, everything to do with, building and, introducing founders and funders together, educating them on capital raising, equity raising, debt financing, etc. That was basically my main role. All right, so I just had the chat open on the side just so I can keep my eye on some of the questions that are coming in. All right, so to kick things off, Silicon Valley Bank, we've been in the industry for the last, I guess, 40 years. Originally headquartered in Santa Clara, California. We've now since branched out and become a more sort of globally focused bank that works exclusively with technology and innovation companies, startups. So we work with companies that are, from seed, a little bit earlier from that, all the way to beyond IPO. We've got a list that is about 25,000 clients long. We're in 44 cities, 9 different countries. I think we have around like more than 4,000 employees right now. So it's a massive sort of banking operation And one of the main things that makes us unique is that we actually also bank VC and private equity firms, which actually puts us sort of in the middle, or the intersection between founders and funders, which gives us extremely unique insight and extremely sort of unique sort of a look at who's fundraising on both sides, who's who's approaching the end of their fund on the equity side, and basically if there's any founders trying to raise, we can definitely make some introductions there, because at the end of the day, we know the who's who on the VC side, and we also know the who's who on the startup side. Right at the top of the screen, you can kind of see the different verticals that we're in. We're pretty much in everything. We're pretty much involved in all the different sort of verticals and spaces. I think it's easier for me to explain what we don't look at, which is anything within the cryptocurrency or anything within the cannabis space. But everything else we actually tend to look at. We're basically in all sorts of different deals across all sorts of different countries. In the States, for example, we're in I think we have market share of 50% of all venture debt deals, actually, which is kind of crazy to think. Moving on, these are just some of the highlights of some of the stats for the bank. I'm not going to really spend too much time on that one, but yeah, talk about the agenda today. Yes.
Yeah. So there's a question that's actually interesting, maybe before we jump right into the content. It's general about what's happening in the market. And while you answer that, it's from Charles. So here's the question. I'll read it out, and then I'm also going to launch the poll. So you have an idea of our audience, how many of them have fundraised before and how many have not. So the question from Charles is, how does valuations really work? A company like Apply Board raises 100 million and hits unicorn status, but a company like Squire announced a new raise yesterday, totaling 100 million raised, but valued at 250 million. Why the difference in valuations? Oh, sorry. They're only valued at 8. So I guess the real question is, why is there such a big difference in valuations?
So that's a
I meant only valued at.
Oh, okay, yeah. No, I noticed that the 8 was the shift 8 to kind of like denote the correction there. Yeah, that's a good question. So basically, when you're raising at valuation, and I think it's mentioned later on in the slides, and if not, then I can touch upon it here real quick. There's a lot of factors that go into what price a company ends up sort of raising at, and what it's sort of worth, or what it's valued at, basically. It's a mix of a few things. It's a mix of revenues. It's a mix of the different sort of assets and activities that it actually has. It's a mix of how fast the market is actually, the market that it's in, and how fast that's actually growing. And it's a mix of also, funny enough, a lot of the valuations that you see today that startups would actually raise at are very much affected by what's happening in the public markets. Because one of the things that sort of VCs do when they're actually discussing this with you, and when you're in negotiation, is they try to get a sense of, hey, I'm investing in Charles, and in Charles's company today, and he's asking for a specific valuation. What they'll do is they'll go and search out the Bloombergs and the Reuters sort of like indexes, figure out any comparable companies that have exited later, that are in the same sort of industry, in the same sort of vertical, but have exited later, and at what multiples they've actually exited, and what values that they're actually raising at currently. Like, so anything between IPO and they're actually looking at all the different sort of companies along the way, and kind of measuring the different valuations, figuring out the minimum valuations, the maximum valuations, and the averages. And at the same time, running different scenarios on their end, being like, well, if I put 2 million in your company, what's that going to give me, sort of like as a projection? There's a lot of calculation that goes into that. So depends a lot on not just public markets. I just said, like, there's also revenues, there's also the growth, there's also just the assets, the IP, how well they're doing, what percentage of market share that the company has. And it just depends also on how bullish the founders are in terms of wanting to grow and, sort of like really, take the industry or take the vertical by the horns, or, how bullish the investors are. So I hope that answers the question.
Thanks, Lay.
Yeah. Okay.
I also shared the results of the poll, just so you have an understanding of your audience here. We have majority in attendance that have not fundraised at all before, and not even sure exactly what might be a good fit in terms of investment vehicles. So here to find out. So yep, right back onto you.
Awesome. All right. So just gonna close that real quick. All right. So I really like this picture, and I'm really, really happy that I found this picture. But yeah, so we're going to talk a little bit about the rounds. We're going to talk about like our understanding of, we're going to talk about the rounds. We're going to talk about the journey in general. We're going to talk about like, how do you qualify investors. We're going to talk about valuations, term sheets, and the various sort of instruments in there. Talk a little bit about cap tables as well, and then wrap it off with all sorts of wonderful questions from the audience. Rounds. Here to tell you that rounds in general have changed somewhat. And I mean by changed is that seed in itself has become more sort of like a very fluid phase rather than a specific stage. So the vernacular used to be, that Sweeney would, start up her company, raise a friends and family round, talk to some angels, go raise a seed, and then go raise a Series A. Then all of a sudden, over time, it became, Sweeney would raise a friends and family, talk to some angels, raise a pre-seed round, raise a seed round, raise a Series A, and then go onwards. Then it became, there's a pre-seed, there's a seed, there's a post-seed. And it just sort of kept changing because a lot of founders started raising multiple seeds. And seed has now changed into what is known as a phase. Seed has now become a phase. And to kind of be able to sort of like, work that into what the founder journey looks like in terms of funding, many have sort of settled on the stages being early, which is pre-seed and seed, whatever those phases are in there, inside there, but that's what it's labeled as. Series A, which is the sort of like the turning point for the company that, when it starts standing up on its own 2 feet and now starts to really look at expanding and scaling. And growth, which is where, you've got your market validation, but now you're going, you're now focused on more sort of certain geographies and adding more and more products and, growing your team. So growth is basically your Series B and above. But that's not our focus today. You'll find there's lots of links throughout this entire presentation. I've already shared this presentation with Sweeney. She'll share it with you. The entire point is you can read the slide, get the 101, understand it, and then go about your day. Or if you want to, the links are there for you to, to give you a little bit more understanding, like a little deeper level, and to kind of get the gears churning so that you can start, searching out more and more sources yourselves. Oops. Yeah, there we go. And one of the main questions that comes from the different rounds and one of the main questions that comes from different sort of fundraising for early stage founders is, do VCs really invest in the team or do they invest in the idea? Or, this is something that you may have heard when you actually speak with founders, when you speak with either angels or you speak with VCs or, whatever. You'll hear the very generic or very sort of, cliched phrase of, oh, I invest in the team. But what does that actually mean? I invest in the team. Like I can invest in the team right now, but there's no sort of like real sort of, I guess, explanation or in-depth discussion as to like how they arrived at that specific point. Yes, you want a successful team that can execute and that can actually win. But the issue is, what is the thought process behind it? So how did they actually arrive at that sort of abstract of being like, I want to bet on the team and not the idea. So on this slide, it might seem a little crowded in terms of like the imagery. So the left image is taken from a paper from Harvard Business Review, also linked on the slide. Also really, really heavily recommend that you actually go read this paper. So they talk about timing is everything. So yes, VCs do actually invest in team, but it also has to be at the right time. So you'll notice that there's industry curves, right, with different sort of slopes. The entire idea is that a VC is looking for an industry slope that is steep enough where every dollar spent in a company or every dollar invested in a founder will take them far and will also generate that return. So that vertical bit, in terms of, when they exit their shares, and pass the torch to the next round of investors. So the other factor that needs to be at play here is you've got a steep slope, which denotes that the market is growing extremely fast. There's heavy demand, but there's basically no supply for it. So there's you, the founder, but there's other founders there with you that are also trying to build similar products, or basically your competitors. That's where the team comes in. That's where the idea of I invest in the team comes in. They want someone to execute, to beat the other people, so that you can actually grab as much of that market share as possible, climb up, and basically generate their returns. And to kind of just give quick takeaways on this, they're looking for, they basically start operating at the industry sort of like the mid part of the slope, denoted by high and fast growth. There's a steep incline. The steeper the curve, the better it is. Market maturity is something that they also really care about. So VC money, which is kind of funny, it shows up at the adolescent period of the company's lifetime. It's during its awkward teenage years, where you're constantly pivoting and you're constantly trying to figure out, who you are as a company, and trying to figure out, your identity as a company, and what you're doing as a brand, and who your value, what your value prop is, who your target customers are, etc. Which is kind of funny. But you're in that mix with similar companies, and you're facing the same challenges. There's a lot of demand, very little supply, and it really does come down to the talent differentiation factor. That's the team. That's why they invest in the team. And it also sort of denotes so if you look outside of the red rectangles, you'll see where the curves either taper off or they keep growing. They're looking also for that to kind of just keep, to keep increasing. So you'll see it in the middle on the left image where it says winner, where, the public markets continue to rise. There is growing demand. They hand you off to the mezzanine and the private equity firms. And then obviously when you go into the public markets, you generate that even bigger return. So back to Charles's point, actually. So back to your question, Charles, earlier. These curves are basically what's really studied when they're actually looking at valuations as well. It's just to kind of see like how the increase and how the inclines are, and kind of see what the public markets look like. Obviously, just to kind of give this a little bit more relevance for today, things have changed obviously because of COVID. The steepness of the curves aren't as steep. They aren't as attractive just because of what's happening, with industries shutting down, with things kind of falling apart in the very beginning. Things are kind of back, but they're more for the series A and above. Seed unfortunately took a big hit this year. This is just a better breakdown of like what that, who the different players are in the different stages. Again, this is shared, so you guys can actually read this and really sort of figure out who the different players are at the different stages, and it kind of helps you understand how you should be thinking about when you're looking to kind of raise. Sometimes the rectangles will stretch a little bit farther or be a little bit shorter than their respective phases. Sometimes angels will stick with you into into the Series A if they have the money, or if you found someone with enough money to kind of just provide you with enough capital to sort of support and keep pushing you there. But this is a very sort of like a general idea of what things look like. Again, talking about sort of the rounds and how they visualize. Let's putting a little bit of putting a few numbers on the different sort of rounds as well. Series A here in Canada, at least, you're looking at 5 million plus, or rather, I think 3 to 5 million rather would be a little bit sort of more accurate here. 3 to 5 million and then onwards. Seed, I just kind of put the arbitrary sort of like 1.5 million is that I started seeing that more and more. But generally, I've seen people raise less. I've seen people raise like maybe 1 million, 750. but it caps out near the sort of like the 4 or 5 million. Again, I've seen lots of strange and sort of like unique rounds. I've seen people at the DMZ raise a 5 million seed. I've seen people raise a 4.5 million seed at stunning, eye-popping valuations. But then these are, I mean, it's not a one size fits all, right? It really depends on where you are as a company, different revenues, what the outlook in the market looks like, any IPs that you have, revenue generation, month over month growth, etc. And then just to kind of give you an idea, each round you're looking to dilute yourself between, I guess, 10 to 25% or 10 to 20%, I would say, per round. These are just things that you should kind of keep in mind. And these obviously depend on negotiation. They also depend on who the investors are and what kind of value they bring. Just a quick note, great investors bring a whole lot more value than just the cash. And I know you've probably heard that at the DMZ several times, but this is just me reminding you of that, of that statement. All right.
Sorry, Liv, I think Charles had a question about the J curve in the previous screen.
Back one slide, please. Okay, so starting on the left-hand side, you're dipping down. You're getting a little hook on that J. You hit the bottom, you start coming up. When you have an idea,
Charles,
concept,
we can't hear you, Charles.
Can you raise that? Can you raise it?
Can't hear me at all. Hold on, give me a second here.
Well, yeah, it's okay. I can hear you. Perfect.
Now? Can you hear me now?
Yeah.
Yeah, okay, I just had to switch microphones. Sorry, my internal's busted. I have the external here. Okay, so back to the, no, not this one. Next slide, please. Okay, so the J curve here, you dip down, you're spending your own money, your family's money, whatever it would be. Then you come back to hitting zero, just above concept there, idea, concept, discovery.
Right there,
At that point in time, when you're going from the bottom of that valley up, what's happening there? Because like you're still super early and you're saying idea, concept, discovery, but it suggests that you're generating funds. So is it the grants propelling you there, or are you saying that there's actually sales coming in?
It's just when sales start to actually come in. It's just when you start getting your first like LOIs, you start getting your first pilots, you start getting your first paying customers. And this is usually the point where you actually start having proper recurring revenue, just like right at the beginning of it.
Okay, so between discovery and validation, you have like a bit of a spike there before it just starts to gradually come up into that curve. So that's when like they put an influx of money into you to propel you forward, and then it gradually builds on its own based on revenue and scaling.
Yes. So basically what's happening here, is like, so picture this, you have a company, you've spent your own money, and this, that's sort of like your, that's sort of like, your little dip, the valley of death. So you're basically going through that period. You hit that inflection point where you now start making, actually in the valley of death, as you're actually starting to curve upwards, that is you making irregular or semi-regular recurring revenues. So this is like when you have like your first customers that, you start doing a little bit of side work for. You start doing, you're first figuring out your pricing. You're, doing some pilots and starting to get like a little bit of money through the door. You hit that inflection point. All of a sudden, this is the point where you've kind of got your validation of the concept of your business model. This is the point where you start generating, like right at the beginning, where you actually start having consistent MRR, where it actually starts looking like you just got your balance. You just started standing on your own 2 feet. You're a little bit wobbling. There's a few sort of awkward steps here and there, but more so you've actually figured it out now. But you now need to start tweaking a little bit more. Boom. This is when people start basically investing more money in terms of helping you scale and grow faster. And this is basically where the angels actually start to come in.
So that was going to be the next question I was going to ask. Now, I can see like angels seem to start to come in right when you're at the very bottom of that valley. Is that typical for all ideas, or is that typical only for maybe certain industries based on trends that you see?
It depends. So with angels specifically, that's a very tough, it's a very sort of like tough answer to have because it just differs so much between individual to individual. Again, angels are just high net worth individuals. It could be a dentist, it could be a lawyer, it could be a surgeon, it could be a marketer, etc. Very picky, very choosy about what they get into and when they get into it. If they see the idea and they actually see the potential, they actually might come in even earlier than that. but you might have some that don't. You might have some that tell you this is not great, and I don't want to, I don't want anything to do with it. Some will sort of like come as early as the very beginning, where as soon as you've built something like a beta product or an early sort of software prototype, they'll actually come in and sort of help you out. Those are sort of the more experienced angels, I find, the ones that have invested in sort of like multiple companies. But yeah.
Thanks a lot, man.
Yeah, no worries. Okay, so there we go. So we just talked about this. We talked about dilution. We talked about investors. All right. The other sort of takeaway that I want you to all have is just the idea of basically what the numbers game that's going on inside the heads of most venture capital funds. There is a return they have to give at the end of their fund, right? So what happens is I'm a VC. I go raise from Sweeney, who is now my LP. And I also raised from Bemi, who's another LP of mine, right? They basically constitute and help build my fund, the fund that I'm going to use to, let's say, invest in Charles's company. The issue here is this money's a loan, basically. And I've got 5 to 7 years to return that money to both Sweeney and Bemi at a multiple return. So if I return $1 for every $1, if I return $1 for every dollar they've invested, I'm not very good at my job. I've actually generated losses for them because of inflation. Most funds don't really end up generating a lot of money for their LPs. In general, it's usually like between a 1.5, like a 1.2 to like a 1.5 multiple. And then very, very few funds end up generating 2x or 3x for their funds. So you can kind of now understand, what they're kind of looking for. They're looking for very high growth, very high ROI generating companies where, I put $1 into your company, I'm expecting something like 2 or 3x in return, hopefully, maybe 5x or 6x if I'm super lucky. But what ends up happening is you end up with a very sort of, it's kind of a grim statistic, but I don't really think it is too bad, where you've got maybe 1 out of 10 ends up being that real rock star that gives you more than 3x return. You end up with 3 out of 10, which end up giving you like a 2 to 3x sort of return. And then you end up with maybe like 6 out of the 10 that basically either give you a 1x or less than 1x return, which is kind of like a loss. That's basically just the understanding of like how venture sort of math works. The entire idea is I'm trying to maximize the number of 3x returns that I'm actually getting. So there's tons of articles on this. There's a really great one on TechCrunch, where someone actually literally builds out all these different case studies of different winning scenarios that says, hey, here's what it means if I'm generating a 1x return for my fund. Here's what it means if I'm generating a 2x return for my fund. Here's all the different sort of investments that I need to make. So yeah, just basically what the key takeaway from this slide is I want you to understand that it really is based on numbers. There really is like a lot of analysis in there. And that's why later stage funds or sort of Series A funds really look at, writing the bigger checks. Because think of it this way, someone goes and raises $100 million fund and they write a check for, let's say, someone that's raising like 500K. So they write like maybe say like 100K or 200K check. If that company ends up 10xing, goes from 500 to like 5 million in the next round, they've only made $1 million. And that million hasn't really moved the needle on the returns of the bigger 100 million fund. That's why most VCs end up sort of falling into, and it's not really a trap per se, it's just basically a natural evolution of the different funds where, you have a seed fund, does really great returns, raises a bigger fund, and all of a sudden they move upstream. They move into the Series A phase. They move into the Series A and B phase. They move into the Series B phase. And then eventually they're able to kind of generate enough returns and have enough of a successful portfolio that they can actually have another sort of separate fund that looks at earlier stage stuff. Inovia is one of them, I think, here in Canada. But a good example of a VC moving upstream is Golden. They started out at early seed. and are now sort of like squarely in the post-seed Series A and a little bit above that with their newer funds. Something to think about when you're actually approaching different VCs. On that note, when you're looking at raising in general, there's probably three main things that's on a founder's mind, or should be on a founder's mind. There's your runway, how much time you have left before you run out of cash. There's the burn, how fast you're moving towards that cliff or the end of that runway, and what your valuation is. You're trying to set the valuation. Obviously, founders try to go high, funders try to go low, and then you try to meet in the middle in terms of all these different sort of in terms of these different negotiations. But these are all sort of like nuances, and there's no one sort of direction or one sort of like step or one sort of like one unified sort of templated way to kind of negotiate your values. It's going to differ for all of you. All companies are unique, and the different people that you meet at the different funds are also unique in terms of just how they decide and how they sort of negotiate and all these different things. It's just there's so many factors there. This is another situation that founders should be very wary of. And this is something that I've actually seen happen at the DMZ. I've actually helped two companies at the DMZ get out of it, but it was not easy. It was very challenging. And this is something that you should actually keep in mind, which is the pinch. So this was something of a concept that was written by Paul Graham in Y Combinator. And seeing this in real life is not pretty. Basically what happens is you think you have enough time to raise, but you don't. And you end up careening towards like the end of that runway. And now you've basically got maybe months or weeks left to raise before you actually have to shut down and before you hit the red. And you start talking to all sorts of not so great investors, not so great angels that basically get to decide what the deal looks like, because that's it. There's no other options. You've exhausted everything. You're at the end of the runway. There's no cash coming in, and it's already too late. Please, as founders, please be transparent with your funders. If you already have funders on your cap table about this, be transparent and communicate, with the DMZ if you need help fundraising, right? Be transparent with, anyone that's sort of helping you sort of fundraise about this, because you do not want to end up in this situation. This is a situation that is it's a very ugly situation. It's a very hard situation to be in. And it's one of those situations where it's kind of, I liken it a lot to sort of like the event horizon on a black hole, where if you see it, it's already too late. It's one of those things where you really need to be sort of like cognizant on. Give yourself enough time. If you think you have time to raise, you usually don't, and always expect that you need more time to raise. Always expect that. Always expect that it's going to take longer. Always expect that the raise is going to be a little bit tougher, because it is. So that's something to keep. In mind. Continuing on the concept of raising, different things go into qualification. The first four here are very self-explanatory, right? Stage, location, sector, and size. Right? These are things that every founder does almost by default. Does this investor invest in the same stage? Do they invest in the same geographic location that I'm in? Do they look at the sectors that I operate in? It's one of the more important ones. Size. Do they write the amount of check that I'm actually looking for? Founders don't tend to look at the last two. I think don't tend to look at the last two enough, which is vintage and activity. Vintage is basically when the VC actually got established, like when it actually set up or when it actually launched. So Scale Up, for example, is a 2016 vintage, which means that when we set up operations, it was in 2016 with a $106 million fund, which leads into the next question of, is this fund still actively making investments? So a good rule of thumb is a fund will typically last between 5 to 7 years. And if they've been around for a little, if they've been around for a bit, for half of that or about 2/3 of that, it usually means that they're now in the back half of the fund. And most of the funds that they actually have on hand are reserved for the follow-on funding. So another thing to remember is whatever fund size a VC has, usually, rule of thumb, 2/3 of that amount is reserved for follow-on funding. That's reserved for their portfolio and not new investments. So 1/3 is usually reserved for the fresh investments. So when you're looking at vintage, especially activity, we'll talk about that one in a second, how much of that 1/3 is actually left to actually make net new investments, new logos on the board, which leads into activity. How many checks are they writing a year? You've got some VCs that are literally okay with just doing maybe 2 or 3 investments a year and then calling it a day, just because of like how they operate and how complex the deals and how sort of long and sort of strenuous like their operations tend to be. So those are 2 main questions you need to ask. How old is the fund? i.e., does it still have enough money, or does it have money for new investments? And then B, how active is it? So these were 2 questions I used to ask when I was at the DMZ, and we were sort of filtering out investors to bring into the DMZ to meet with you folks, which is great. We would actually ask them like, hey, how long has your fund been in operation? And are you guys still writing checks? Have you written a check in the last 6 months? If not, why? Are you out of money, or are you just not an active investor? If you're not an active investor, or if you don't have any money, we're not really interested in having you in the space, because we want to get our founders funded. 2 really important questions there. I see a quick question. SVB ticket sizes, are they the same all over the world? I ask because lots of seed investors this side of the world tend to demand large amounts of equity for relatively investment, certain market access. All right, cool. I do think we have the same ticket size all over the world. I think it's like more standardized everywhere. Our venture debt, just real quick, our venture debt tends to start at the Series A, so 5 million round, presence of investors. Those are usually sort of like the main, like the 2 first sort of check boxes that we kind of look at, and then we start looking at the recurring revenues there. But we'll talk about that in a bit. I can talk about that more a little bit later. There's another question that just popped up before that. Is it trending that investors are becoming more location agnostic as a result of COVID-19 and the world becoming smaller due to e-meeting? Kind of. You've seen some people relax like the geographic constraints. They still exist, but you've seen people relax them a little bit. You've also seen, like, I've seen some investors just retreat for the entire year and just be like, nope, we're not doing anything for 2020. Like, screw this. We're not doing any investments. We're gonna wait until COVID blows over. There's a little bit of that. I've seen some like super active investors write like 6 deals in a single week because hey, e-meeting has made it so much easier and faster for people to chat. Or are there still lots of regional restriction preventing just anyone from investing just anywhere? Again, it depends. And I hate saying it depends, but it actually depends. It is a very interesting question. It's a good question, Charles. I've seen some funders relax that criteria. Not everyone, but I've seen them understand that, like, hey, you know what? We don't need to be where our founders are or where our prospects are. So we can just kind of take it from there. Let me just check if there's any other question. Oh, it's just a J-curve question from there, so I can kind of continue. Okay, cool. From this slide, treat your raise like a sales funnel. Basically, the better you qualify investors and you fill that nice top of funnel, the more you're going to have potentially closing. And use lead as momentum, especially in Canada. Canadians don't like to lead rounds. They don't like to do the paperwork and price the rounds and do all that heavy lifting. If you find a lead investor, do so and use that. Just use the heck out of it in terms of when you're trying to like build out momentum for your round and actually say like, hey, we have a lead investor, we've got commits, we've got people that are coming in the round, soft circling, etc., verbal commits, whatever it is. Lead is probably the ultimate momentum here in Canada. Probably the quickest way for you to secure and close out rounds. Again, I've seen founders raise like a 6 million round, but it never really closes because you don't have a lead. So everybody is just sort of standing at the edge of the pool, and they're all just kind of looking at each other, waiting for the other one to jump in first and be the lead. And the money is there, you just can't touch it, and it becomes very sort of stressful and frustrating for the founder and the funders, actually, especially the longer that sort of stretches out. Term sheets. Basic documents, they basically lay out the initial sort of points for the round, the major terms, who the lead investor is, what the different sort of equities and the valuations are, who the different players are, what the different sort of demands are from the VC side, reporting, organizational, if there's board seats, valuation, dilution, shares, etc. It's written and negotiated by the startup and the lead investor usually. That's why people don't really like to lead, because you actually have to like do that paperwork, which is kind of funny. You can receive multiple term sheets, and they're usually sort of combined into one towards the end of the round. And then once it's signed, or when you receive it, rather, you start going into due diligence. And I put an asterisk there because sometimes what will happen, and what we used to do at Scale Up, is we used to do due diligence first and then give you the term sheet. That is a different method. Is it a worse method? Is it a bad method? No, both methods are fine. Our philosophy at Scale Up at the time is we didn't want to issue a term sheet, say to Sweeney or Bemi or Natoya, and then go do due diligence and then find something and then come back and be like, yeah, about that valuation, we're going to knock it down. Or yeah, about that ticket size, we're going to give you less money now. We didn't want to sort of like renege or, go back on any of our words. We much preferred to actually just go fully through due diligence, figure out everything there is to know about this company, and then come back and give it a fair pricing and give it sort of fair terms and deals. It's just that was our approach. Is that to say the other approach is wrong, deceitful, or anything like that? No, it's not. It's just a different way of doing it. It's just that our preference was we just wanted to be as fair and as upfront and as transparent as possible. And we didn't want to have any sort of like beating around the bush or any going back on any of our terms. Valuation. That's what Charles asked right at the beginning. You can kind of see that when you're pre-seed and seed, there's a lot of estimation or guesstimation that goes into it. How do you actually price it? How do you actually price a company? There's a lot of it that really sort of goes into estimation. I mean, how do you value two folks or three people on a laptop that have like a beta application and like no revenue, right? How do you actually value that first round? There's different instruments that can bypass the valuation. We'll talk about safes and convertibles in a bit, but it is hard. It is hard to actually come up with that guesstimation. Seed, as you get more sort of traction, as you get more sort of metrics and KPIs, as there's a little bit more tangibility to the business, we're able to do a little bit more valuation. And at the Series A, you've got financials, you've got historicals, we've got public markets and forecasts and all sorts of different trends and everything to to kind of see. Makes it a whole lot easier for VCs to kind of do the estimation there. Hope that's not working. These are just some key terms for valuations that I'm not going to go over right now just because it's a little too time consuming, but these are in there for you to kind of figure out what you need to know in terms of if you're thrown any terms, if you're thrown any definitions. You can come back and you can refer to this. These are quick ways to kind of estimate what your valuation is. So how do you calculate post-money? It's simply just taking pre-money valuation, adding what sort of investment you're looking for, and then voila, you got your post-money. And if you divide your investment over the ownership equity, then you get your post-money. Or if you divide your investment over post-money, you actually get the equity that the investors are actually going for. So there's different ways you can play around with these equations. These are just like really quick estimation techniques for you to actually figure out where you are and figure out sort of like what kind of amounts or what kind of ownership you're going to end up with and what kind of valuations you're going to end up with. again, you can play around with these equations and everything. Yeah, everybody's getting a copy of this presentation anyway. Notes and safes. So basically, they're IOUs, and I know these are very hotly sort of contested and discussed instruments. Basically, they're almost the same thing. A note and a safe, I mean. So convertible note, just taking the quick sort of definition from the slide there. Convertible note, short-term debt that converts into equity. Safe is essentially the same thing. Essentially, it's just that it's minus the interest rates. So going into a little bit further, notes have an interest rate. Safes do not. Notes are literally an IOU, except the IOU will turn into shares at a later date, or it can be paid back, right? You actually have the option of just paying off the note from the investor and going about your way. Usually you don't. Usually what it does is it converts into shares at a discount of the next sort of price round. And basically, they can either be capped or uncapped, which depends on, what kind of valuation you're trying to set or not. And then also, unlike safes, notes have a maturity date as well, which means after you sign that IOU, there is an interest rate that is, that starts getting accumulated. And then there's a maturity date where you either pay up the amount plus interest or it converts. So it turns into its own sort of instrument. Safes don't really have that. Safes are pretty much just they're literally what they're called. It's an acronym. It's a simple agreement for equity. And it's basically just an investor giving you an amount of money at an agreed upon sort of time, being that the next price round is when they convert into shares in your company, right? And it's a very simple document. And it's lovely, or is it? Because now we're going to talk about the advantages and disadvantages of both. They both have really good sort of intent when it comes to helping founders. They're supposed to be less costly, less complex, and basically hence a lower legal cost, lower time, and just faster to get you the money so you can get back to building your company. And they're also super useful for founders that can help you kick the valuation down the line, right? You don't actually have to figure out what your valuation is today. You can figure it out at the next round, which sounds lovely, except not always. But anyway, to talk about it a little bit more, on the convertible note side, historically, it was really good for smaller rounds, and sometimes it's actually used as a bridge between rounds. Lower legal cost, less time dedicated, and the debt converts at the next price round. It's a very simple mechanic. Or the debt converts at the maturity date, rather. The problem is debt is still debt if you decide to pay it off and you don't have money, and if you end up not raising, because the entire idea of how it converts into shares is the fact that you go and raise a price round. If you don't raise a price round, you still owe someone money. And knowing early stage companies and their relationship with cash, which they just don't always have it, that becomes a problem that can actually end up killing the company. So that's just sort of like something to keep in the back of your mind. Kicks the valuation down the line. Again, if you end up raising at sort of differing valuations, or if you end up raising multiple rounds, and if you have multiple notes, you will end up with a nightmare of sort of legal and sort of accounting work to do. You end up with a very, very, very insanely chaotic cap table, especially if you have like 2 or 3 notes or more. You actually end up paying a whole lot of legal fees so that you can actually untangle that mess, because you've now got to figure out where each one sort of converts and for how much it actually converts and what the dilutions are for each one. And obviously there's also tax implications there where it becomes also kind of strenuous, where I guess it's on the investing side of things. Yeah, I think there's like fees being paid on the tax side of things. The tax side, do ask lawyers, do ask accountants. You've got them at the, you've got them with the PIR program here at the DMZ. I'll leave it for them because I think since tax laws kind of change every once in a while, it's best to kind of just check in with them about these things. But there are tax implications for both. Safes are now a little bit more complex because they used to be calculated on the pre-money. And being calculated on the pre-money made it extremely stressful and extremely chaotic when you raise multiple safes at the early stage. The math got hard. Funny enough, and I know how funny that sounds. Math got hard, super complex, and a simple agreement ended up not being a simple agreement. And what ended up happening is founders and funders ended up being diluted a heck of a lot more than they actually thought they were. And they would just easily blame it on the next equity round. Y Combinator eventually changed things and updated the agreement to convert on post, making it a whole lot more easier. So it's much easier to figure out who's who and who owns what in the new safe and who's getting diluted. Again, just like the convertible note, it costs less. There's less legal fees. It's a lot faster. All these different things, and it also kicks the valuation down the line, which is not always so great for dilution, for dilution purposes. But I will say this: with the new safes, founders still got diluted more because what could happen is you can raise multiple safes, and what is happening is, sorry, I'll take a step back. In the old safe, if founders raised multiple safes, the founder and the funder were both getting diluted along the way. Eventually, when you raise a priced round. For the new safes, you're kind of snowballing them together, and then when the founder raises a priced round, they're the ones that are sort of taking the hit on the dilution or taking the majority of the hit on the dilution. So yes, founder and funder both get diluted, but founder ends up getting diluted a little bit more. So that's something to keep in mind if you're going to raise multiple safes or even multiple notes if you want to untangle that mess. The other sort of disadvantage that I've seen is a lot of safes end up getting modified. The entire idea is that it's a simple agreement for equity, yet sometimes investors see a fit to kind of just play around with some of the terms and conditions and start adding all sorts of different clauses there and just ends up complicating it. Don't do that. Just use a template. Template's right there. Just change what needs to be changed in terms of companies and addresses and amounts and whatever, and then just take it from there. Nothing more needs to be done there. Key takeaway from here: just be cognizant of raising multiple safes or multiple notes. There's a lot of work that goes into them, and they end up not being so. Sort of simple. Few sort of questions just came in, so I'll take a break for a second.
Do you want me to read them out to you, Leif? Is that easier?
Sure. Okay.
So I think you answered the ones from Charles and Sabello from South Africa. So John asks, in terms of time, how long does it take the average startup to go from seed to Series A? I know it depends, LOL, but average time.
Yeah, I mean, so the depends part is the month-on-month growth. So Series A is usually denoted by the fact that you hit a specific ARR, so the annual recurring revenue. So if you're able to go to an annual recurring revenue of about, I want to say 1.5 to 2 million a year, you're now in the Series A, because if you're going to raise, you're not going to raise less than like 3. You're not going to raise less than like 3 or 4 million. That's basically what Series A is. So I don't know what that means in terms of time, but think of it that way. If you're racing towards an A, you're going to want to get to sort of like that range of revenues.
Perfect. That answered the question. Thank you.
Oh, awesome. All right.
All right.
In terms of months, I don't know. Like, usually what VCs like to see is that like you're raising money every like 12 to 18 months. Because again, high rate, right? You're looking at that slope and you're looking at like that growth. So maybe 12 to 18 months. I'm going to say like that, that range. So whichever comes faster.
Okay, perfect. Thank you. Then the other question is from Tai Wo. Who determines if the note converts or is paid back, the founder or the investor?
That's a good question. And usually that is a negotiated point in the convertible note. So that will be one of the points in the note document that actually says who gets the authority to convert or not. Investors will obviously want to say it's them. Founders will obviously want to say it's them. So it really depends on negotiation and what you're able to get away with. Usually though, I mean, like the notes end up converting into shares anyway. Unless you end up really not liking that person and you just want them off your cap table and, to go about their way. But usually it just converts. So it doesn't quite matter. But that always means do your due diligence on who's funding you and what kind of terms they're funding you with. And make sure you actually like and get along with those investors because they're going to be in your face for a while.
Okay, that's a good point. Thanks. Then the next question is from Vipan. Would you ever have two notes for the US Canadian investors or simply one note for both investors? And if one note, being based in Toronto, is it better to have a CAD safe that is converted?
CAD safe. Yeah, that's a good cross-border. That's like a good cross-border question. Would you ever have two notes for like two separate notes?
Yeah, basically we were going to do it out of the box safe. And then we realized that, I don't think there is an out of the box safe for Canada, and there's different legal stuff. And we know people have converted. So our lawyers have actually converted it, but now a lot of our investors are going to be in the US. So would it be the same safe? And is there any disadvantage that we had to convert to this Canadian safe at all?
No, that's a good question. And I think, what was it? I think NACO tried to like come up with their own version of a safe and like no one ended up using it. It was a great initiative, honestly. Like, and they tried also making it a little bit more Canadian and they called it the Leaf.
Yeah.
But that's a very good question, actually. So converting it and making it a little bit better, like a little bit more sort of like accommodating for the Canadian ecosystem. I don't think there's like a real disadvantage there. I've never actually seen that scenario where I've just seen people just take literally the template and just sort of like use it.
Even the Toronto and even a Canadian company, they just use the US template. Because there's different like.
I think so. It's just making sure that if there's any legality or if there's anything that's like, if there's anything there that needs to be just sort of adjusted for the Canadian market, they did. So I guess that's what you guys did.
Yeah, that's what we did. But then on the other hand, you kind of mentioned, don't alter it, but we kind of had to for the Canadian. Two of our business partners are lawyers too, so they're like, they've done this, and they're like, you can't actually just take this. It's just different rules. So
yeah. So for Toronto investors, yeah. So I think having it converted for Toronto investors is fine. If you're able to do it just on one note and sort of like in a unified currency, I think that would actually be a little bit easier for you.
Okay.
But if it just means for legality issues and just because of like cross-border issues, like this is just the easier way to do it, then that's fine.
Mm-hmm.
I don't see it being disadvantageous either way.
Okay.
But just be aware, like this is, I'm guessing, a single instance of financing.
Mm-hmm. Yes.
So if it's a single instance of financing, I would try and have it combined as sort of like one instrument.
Okay.
Just because again, like what'll happen is on cap table, you might actually have it as sort of two different entries because it's two different instruments.
Okay.
Even though and the company and like the overall sort of company understands that these are like two different instruments that are converting sort of at the same time and everything, there's still two different instruments.
Okay.
And I think you might actually end up running an issue there, especially because I think if you're converting it from CAD USD and the investors are doing USD, there might be a little bit of a complication there.
Okay. No, that's helpful.
So I think my 2 cents if you're able to unify it as one instrument, do so. And yeah, I would run this by, I would probably run this by your lawyers, just to kind of make sure that like, what would this actually look like for my next round? Think that way.
Perfect. That's great. Thanks.
No worries. And then the next question.
Yeah, I'm just going through them because some of them are directed to me as well. So I'm just answering.
Oh, okay.
Yeah, so that's good. Okay. We have one from Nathan. From my understanding, at our current stage, the focus is more on validation with customers. How are we supposed to keep doing validation while generating revenue for future fundraising?
Yeah, I mean so Nathan, that's a good question. I mean, the entire point of you doing validation is that you're trying to generate revenues anyway. So what's going to happen is you start your company. So day zero, there's no real revenues, but you kind of have maybe pilots set up, or you maybe have like a few free users here or there. Every company will end up going through this at some point in their life where right at the beginning where they have zero revenues, they start doing either odd jobs or sort of like a little bit of consulting on the side to generate a little bit of not specifically recurring revenue, but just revenue or sort of like an income for the company to keep the lights on and to pay your employees and development costs, etc. Eventually what happens is you'll start bringing on your first wave of customers, usually at a reduced rate to kind of encourage them to come on board, where you kind of benefit by, you kind of get the benefit by saying, hey, I've got customers. And the customers say, hey, I get a discount. So there's a little bit of sort of like a two-way beneficial street happening right at the beginning. From there, you're still operating with sort of, lower paying customers right now. You're doing a little bit of odd jobs. So you've still got that nice little, revenue stream coming in. Not exactly regular, it's irregular, but it is revenue nonetheless. Eventually you hit the point where as you're, obviously through this entire period, you are validating and you are tweaking and you are improving your business model, seeing what works and what doesn't work, how your sales works, customers, what your pricing is, etc., what your value prop is, all these different things. Eventually you get to a point where you now have that model. That model works. When you're looking for new customers, you're looking for new clients, you're looking for new paying users, it's there. You have like this sort of templated approach to it. That's the point where you actually end up having recurring revenue and you start growing that specific method. The entire thing is you're validating the entire way. You never stop validating. It's only until you have your sales process completely sort of or kind of figured out right in the beginning. Like, let me actually just go back real quick right here. It's only in terms of like the validation point. So you kind of see it as like the third column where you actually start seeing external funding. So if you'll notice, the first three rectangles that are stretching, across, sort of going horizontally. Founders, friends and family, like friends and family round is basically, these are familiar faces. Business angels might be people right? Like there's a wonderful article by Elizabeth Yin where she's pitching, I think, to her dentist or optometrist for money as an angel. So like these are things like, these are still sort of familiar faces. It's when you hit the validation period, so column number 3, right at the bottom, on the x-axis, that you actually start to go out and get sort of non-familiar face money. These are people who are external to your circle. This is the first time you start, dealing with institutional investors or, angel groups or people that are outside of your immediate bubble or ecosystem. But how are we supposed to keep doing validation? Simple. You're literally, with DMZ has really sort of great content on this when it comes to sort of like validating like sales and generating sales and building your sales funnel. It's a lot. It really depends on that. You're looking at your sales funnel. You're seeing how long it takes between you first getting in contact with the client and then getting your cost, figuring out all the steps, figuring out what you can cut, what you can shorten, how you can optimize it, and how you can make it scalable and growable, and then just take it from there. validation is always happening, even at the Series A and B level. It's always happening, especially at Series B when you actually start going into different geographies, because Canadian ecosystem does not equal American ecosystem, even though Americans seem to think that. But yeah, so every single market is very different. So there is validation as soon as you enter a new market, for example. That answers the question.
Yeah. Nathan says, great, thanks. So I know we have one last topic to cover, which is cap table. So maybe we'll let you get to it.
Yeah.
I know a couple of people have had to drop off, so we're sharing the recording and the slides with them after, but we have the majority here. So yeah, let's continue.
Yeah, so cap tables are the other end of the sort of like this really technical part of fundraising. What is a cap table? So a cap table basically just shows you who owns what in the company. Right? It's literally an Excel sheet that kind of shows who the different sort of owners are, how many shares they own, what that value is. It shows you the employee stock option. It shows you any sort of outstanding debt. And it shows you all the different sort of rounds that they've raised. So a really good cap table will show you the story of the transactions over time. And that is something I learned from the partner at Scale Up Ventures, Matt Roberts. He will tell you that an amazing cap table is one that you can read and you can totally understand what different funding cycles and journeys that the company has actually gone through clearly. What will happen is over time, it gets a little bit more complex because you've got debt, you've got the convertible notes in there, you've got safe notes, you've got the employee stock option pool, all these different things, like all these different sort of things start to actually sort of pile into that table. It starts off nice and amazing and super simple because it's probably just you and another person. But then just more and more people start joining you on that journey. And it kind of shows all the different shares and as they change and grow over the different rounds. So what's going to happen is your cap table is going to become extremely messy and it's going to become extremely complex. And cleaning it is probably going to start becoming a routine thing that you need to do every once in a while. You do that with a lawyer and with an accountant. DMZ has those. This is me plugging the PIR program again. Talk to the accountants, talk to the lawyers at DMZ, at the PIR program. Let them help you with the cap table because a messy cap table is something that you do not want to deal with. And it's not one of those things where you kind of leave it and forget about it, let it accumulate dust and get all tangled and everything. These are not the wires behind your TV. Make sure that they're actually nice and tidy. Get that, that cable management, done. Make sure that, no dust sort of accumulates on them. Make sure that it doesn't get, too tangled up with, different instruments and different sort of debt options and all that sort of stuff. Keep it clean and tidy. That's probably the main takeaway from this slide. Because at the early stage, it's going to start out simple, but believe me, it gets super complex. And it just becomes more cumbersome when VCs start asking you for a cap table and you give them one where it's like extremely hard to read. Lots of cool sort of resources in there. To the note earlier that when we were discussing like the different sort of safe options and everything, some of these sources are US, so keep that in mind. But the read or the read resources, like those generally apply everywhere. And yeah, so you'll notice, again, I was talking about this earlier in the stages and the rounds, your ownership will go down. It's something like if you decide to go down the diluted or the dilution route, you will notice that you will start giving away more and more of your company. Orange line is the average. Orange line is the average. So you're basically giving away anywhere between like 15 to 25% or 10 to 25% every single round as you're going. Yeah, so I think that kind of wraps it. There's just a few resources here in the back for you guys to take advantage of. Different sort of tools, different sort of blogs, different sort of Twitter accounts, I think, books, newsletters, etc. For you guys to go and read if you want. And I think that kind of wraps it. So if you have questions, I'm happy to take more questions right now. And as a quick reminder, I have office hours every Thursday, except this Thursday, from 10 to 12 p.m. You can find me, I think, on the portal. Come talk to me about this presentation. Come talk to me about another presentation that someone gave you. Come talk to me about seed Series A, debt, U.S. financing, everything VC related. You need help with your pitch deck? Happy to chat. Business models, happy to chat. Connecting with VCs, investors, all that sort of thing. Happy to chat there too. So yeah, so I think there's more questions. So I'm just gonna.
Yeah, just keeping an eye on them as well. So there's a question from John. What's a rule of thumb for splits for the cap table? Should we generally allocate 40% for investors, 12% for employee stock options, etc.? What are your thoughts on that?
Yeah, so what's the rule of thumb for splits for cap table? So I don't know what exactly you mean by sort of like splits on the cap table itself, but just think of it this way. When you start off, it's going to be you and your co-founder, or just, you, if you're a single founder. And you're going to have like either 100%, it's going to be split between you and the co-founder, either 50-50 or 70-30, 60-40, whatever it is you've decided. As you start going through every round, you start giving up anywhere between 10 to 25% of your company. And that 10 to 25 comes out of you and your co-founder. And then in the next round, the next 10 to 25% comes out of you, the co-founder, and the investor. And then usually by the time you hit Series A, or like a post-seed, you're looking at the employee stock option. And sometimes what they'll want you to do is they'll want you to do the employee stock option post. I think it's like a post as part of the post round, which means it usually comes out of you get diluted a little bit extra. And then founders will definitely want to have that employee stock option allocation happen before the round, which means you're giving up less equity, and there's less equity being given out to the investors because the ESOP is being taken out from that pool. That's a negotiation thing. So it could go either way.
When it's all said and done after post Series A, and for now I'm a single founder, so are we looking at about 30-40% for myself? I know it depends, but
yeah. So let's say so let's say right now you just started today, you raised a seed, gave up, just nominally speaking, you just gave up like 15%.
Yeah.
You raise your Series A, you give up another 15%. That's 30%. You still own 70% of the company. But usually how it would go is you give maybe like 15% now, and then maybe like another 20 or 25% later. So that's 40% that you've given away. So you still own like 60%. And then you want to give out a chunk of that to your, to the employees as part of the ESOP. That also kind of depends per round, I guess. And it depends on like what you're looking to actually set aside. So if it's like, let's say 10%, they'll try to get it out of you. So you'll end up owning anywhere between like 50 to 60%, something like that. There's lots of great literature on this online, where you actually kind of just look at all sorts of different scenarios. There's also, I think, different tools where you actually get to just play with a few numbers. So cap table tools, I think I've linked a few, but just check them out. It's like you go in, you fill a few.
Yeah. Love those conferences.
Yeah. You actually get to see them play out. Venture Deals' course, or Venture Deals, I think, has a tool somewhere on there. Like if you search Venture Deal, like cap table, like tool or something like that, like it will actually give you the thing. And it'll be like super easy for you to actually not only see it in terms of numbers, but I think it also shows you as like graphs and bar charts, which is, for me at least, a whole lot easier because it's like a little bit more visual for me to understand the sort of like the trends and how it's actually going. I hope that answers your question.
Yeah, that totally answered the question. That sounds like super fun. I can't wait to jump on that.
Yeah.
Right,
So there's,
Awesome. I am just also looking at some other questions. There are some more here. We'll jump right into them, but I see also people might have to leave. So I just want to say, we'll keep continuing with the questions. If you do need to hop off, quick note, Late is available for PIR office hours. If you have some urgent questions or you just want to get some more information, you can find me on Slack as well. So Sweeney, SWEENY at ryerson.com. I'm just going to put it in the chat. Email me anything if you need some help. Laith has his email on there too. I'm just going to put that in here as well. lshukri@svb.com. And then just so you know, this is being recorded and the slides and this recording will be shared to all the participants that attended and registered for the webinar, because I know some of them couldn't make it as well. So before we continue, just a big thank you to Laith for his time. Thank you for all the participants that showed up, especially Bemi and his cohort of the Black Innovation Program Bootcamp participants. You guys are doing such great work. I know you have jam-packed schedules and you're figuring this out. So we really hope that this was beneficial for you. So thank you for coming and joining us. And now I think we will continue with the questions. So we have, let me see where I left off. Okay. So
there's Natoya just asked, how common is a forced exit scenario and exit horizon? Exit horizon, do you mean just as about just about like before you go into like IPO, or do you mean, or are you referring to the pinch that we talked about earlier, or do you mean like what exactly do you mean by exit horizon?
Yeah, so it's more, but I was actually referring more to the pinch that we were talking about before.
The pinch.
Yeah.
Yeah. So again, like it there's a lot of factors that go into this. It really comes down to whether you can kind of pull something together at the last minute and sort of like get like any sort of like financing through the door. Usually what ends up happening is there's a lot of costs that end up getting cut. Lots of people end up getting let go and laid off and all these different things. It's a very ugly scenario. It's not a great scenario. Like I remember I was sitting at I was sitting at my desk at the DMZ, and then the two founders literally just come up to my desk and they're just like, oh, hey, we're about to run out of money next month. And that was it. And I had to work with that for the next 2 weeks, where everything got put on hold on my end, all emails, I was just ignoring everything that was coming through, and I had to focus on helping them get money, because otherwise they're going to tell their team of, they had a team of 10 at the DMZ, and they had a team of 20 outside in a different office. They were going to tell them all to go home because they just didn't have enough money. Luckily, we pulled through. Company's doing very well now. It just closed a 10 million Series A, and growing very fast. But yeah, it's forced sale, exit happens. It can outright kill a company just because they don't see how early they should start fundraising. Founders also treat fundraising as a very periodical element, where it's like, I fundraised now, I don't need to fundraise until I need the money. That's not how it works. You're the CEO, you're always fundraising. You're always talking to investors. You're always bringing up the next round. You're always talking about the next round. You're always talking about the next stage. So you need to really keep the momentum going. Eventually your team gets big enough, and that's pretty much what the CEO keeps doing. Just, constantly hitting the road and trying to, close more investors in fundraising. And then you leave the rest of the work, to the other C-suite execs and to your very capable management team that hopefully you've hired. But yeah, basically that's what the company turns into. And there's a very weird sort of bittersweet moment where you're the founder of the company, but you're no longer involved in its micro day-to-day on the ground operations. You kind of step away from that. I've seen it happen with CTOs where they start missing the work that they've done, because they start, the platform that they built, they no longer actually sit there and fix. It's now managers that are working under them and employees that are working under them as well. So that's what ends up happening. You're always raising, and it's just always assume that it's going to take you a lot longer than it will, and you're going to get a lot more no's than you will. So just constantly try to raise. Next question. Can you comment on raising funds from the US as a Canadian company? Is it better to incorporate in the US? Eventually you will end up, expanding into the US if you keep growing at a specific rate. And it's not because like, hey, the US is better, it's a better environment, better economy. No, it's usually also because of the fact that there's not enough late stage capital firms in the Canadian environment, right? We don't have enough like really growth, like late stage firms that can actually sort of like write big checks. I'm talking about like 50 million or like, 20 million or, whatever it is million. We just don't have that in Canada. We don't. So most companies end up moving to the States where they actually end up having to incorporate in the States. Now, if you're trying to raise a Series A in the States, or if you're trying to raise a seed in the States and that sort of thing, some investors might ask you to have incorporation. Some investors might ask you to have a US incorporation. So keep that in mind. Is it better? Well, it will definitely make it easier for you in terms of funding. And I'm going to plug in the PIRs again here. I'm going to plug in the PIRs again. I'm going to say, talk to the lawyers, talk to Goodman's, talk to Fasken about this. They probably have the most 100% sort of accurate information around this point.
No, thank you, Leif. We do have 5 minutes to wrap up, and I see there are a couple of questions here, so maybe run through them really quick. So when your company is capable of generating revenue to fund new tech initiatives, would you recommend raising money to grow faster or grow slower and steady to save equity? That's from Adam.
So Adam, that comes down to you, and that comes down to how fast you want to grow your company. So I'm actually going to be bringing this point up. I'm doing a panel later, and that's actually something that I wanted. That's one of my intro. That's actually an intro sentence that I'm actually going to be using. It really it depends on the founder. Do you want to grow fast, or do you want to grow fast? But know that if you want to grow fast and scale and grow, you have to give up shares in your company. Or you can just continue to bootstrap and continue to grow at that steady pace, and then raise more money later. I'm personally an advocate of bootstrapping. Take it slow and steady, grow, achieve as many milestones and achieve as many sort of objectives as you can. And then when you raise, you can actually raise at a better valuation, and you can raise at a higher sort of with even more funding. So I would say slow and steady in the beginning. Just take it as far as you can on your own, and then go talk to investors. You always end up with a better advantage of having sort of less equity raised.
Okay.
Thank you.
Thoughts on public markets? They come with a lot of regulations and restrictions and reporting obligations and things. Like, I spoke with a founder that became the CEO of a company that went public early. Just the amount of disclaimers that they had to have on like their pitch deck, because they're now a public company. Like, they actually had to have like a whole slide with like all that, that wonderful sort of like fine print. They had to have that like plastered all over their pitch deck, just because of like, hey, they're a public company now, and there are shareholders. I think it's a lot more complex. It can work in some respects. I don't know if it's a favorable option. Personally, I've never seen a company that I've worked with do it. So I would shy away from this, also because I don't know enough about it. But from what I've seen, lots of complexity, lots of reporting, lots of regulations that you're now subjected to. You're an early stage founder. You have enough spinning plates. Like, you have enough spinning plates on your hands. Probably not. For startup raising pre-seed, what do investors generally expect to see in terms of how funds will be spent? Just getting to your next milestone. We're raising X to do, to increase our market spend, to increase, our hiring, to increase our development costs. They want to see the money go into the operational side of things mainly. You're building out your tech, you're building out your platform, you're building out your service. As you start to progress, some of the funding eventually starts making it way more towards the marketing and the advertising spend, because your product is now finished, and then you can kind of take it from there. What are the red flags investors watch out for in terms of how a pre-seed startup wants to allocate pre-seed funds? What are the red flags investors watch out for? I guess high salaries, if that makes any sense. Yes, investors want you to pay yourselves, But if you're paying yourselves like above market, like a lot above market, like a really, really, really nice salary, you're not a serious founder. You're interested in just, you know, scoring a nice big paycheck and then you just calling it a day. I think that's one of the red flags that they look for. Also, when investors do due diligence, customer due diligence and technical due diligence and team due diligence, they will usually figure out what's wrong with the company, not in a bad way, but like what it needs. And if you're raising purpose doesn't really meet the same needs, or if there's not really sort of like a good overlap between what the investor have found out through due diligence between what you're trying to do, that's another red flag, right? So if we do due diligence and we figure out that, let's say, Sweeney's company needs a whole lot more work on the technical infrastructure, but she's coming to us and saying, I want to spend money on like advertising, that's not good. Things like that. Early stage company looking to raise, is there a database list of places that I can apply to for funding? Yes. Let me just pull that up super fast for you.
Yeah, and while Leith is just pulling that up, thank you so much for your feedback. I did launch a poll while the Q&A was going on, so I'm really happy to see. Leith, everyone found this session very insightful, and I know we're at time. And yeah, so thank you so much, everybody, for coming and joining. Leith, I will let you pull up your resource.
Yeah, I was just gonna mention like last question for an answer that came in right at the beginning. Charles, yes, that is Logan in the back, and that is Deadpool and Spider-Man in the back. Yeah, they're right there.
Awesome. Yeah, so I don't know, Leith, did you send the?
Yeah, I sent it. It's right at the bottom. Everyone, it is. I think it's like innovation. Where is it? Yeah, it's innovation.canada.ca. It's a government portal. It starts asking you a bunch of questions, what you're trying to do, what kind of company you are, and then it starts filtering out all these different things, and it spits out a bunch of different sort of, I think, options for you to actually sort of like apply for. That's on the government grant side of things.
Great, thank you so much. So we're at time, and thank you everyone so much for joining. We've had such an engaging session. I love it. We had a Q&A of around half an hour, which was awesome. So thank you, Leith. I know you're probably out of breath, got to grab like a whole jug of water. You've been speaking continuously for like an hour and a half. Everyone at the DMZ appreciates it, the staff, the founders. We had founders from Ryerson Zones joining in as well, from the boot camp, from incubator, accelerator, all over the map. So we do appreciate it, and we wish you have a lovely day. And as we shared, you will get the slides and the recording probably around next week sometime. We just got to edit it, upload it, and then we'll share everything with you. So thank you everyone for joining, and hope you have a great rest of your week and happy weekend. All right, take care.
See you, everyone.
Thanks.